Jason, it's just great to have you. Thank you for coming. Thank you for being willing to share your expertise and your knowledge. And I'm looking forward to hearing, so how is development managing COVID, and what is your projection on where we're going to go? Because that's the reason why I'm here. You're nice, but I'm here for the knowledge. I'm sorry.
Well, thanks for the warm introduction. I appreciate that. I think development has a good lead time on delivery over the next 24 months. So once it's stabilized, you'll see rents being at where they should be. And the takeout should be pretty stabilized, because by that time, COVID should be stabilized. And so real estate development, it's a weird paradox because you have a lead time, right? And so with that being said, I think real estate development should be, if you have a portfolio, 30% of your portfolio should be in real estate and real estate backed securities. And a sliver of that should be in real estate development, right? That should be your risk reward, bucket. And then you would have private investments into cash flowing assets, REITs, debt funds, equity funds, et cetera. And I'm sure you guys are all kind of knowledgeable of all the different varieties, but that's the short answer.
Actually, I wouldn't make that assumption. I wouldn't make the assumption that we're all knowledgeable. We got some newer investors here. We got some more knowledgeable investors here. So if you could break down some of those buzzwords and the differences between just for a moment, that would actually be helpful. Not that I'm trying to slow you down.
Yeah, no. I mean, no, I was my attempt was to give you a succinct answer there.
I apologize. Yes, you're talking to me. I should have known. So keep going.
No, and I think it's important to note that if you read all the books, right? I mean, one important thing is like, what are the wealthiest people doing with their money, right? And Warren Buffett, right? If you go look at his investment portfolio and you just copy his portfolio exactly, guess what's going to happen over 20 years? Like, it's not magic. You just like kind of do that, right? Same thing with if you hang out with somebody that's like having a struggle in their life and they're not doing well business-wise, and they're having issues with their friends and family, and you copy exactly what they do, guess what? You're probably likely going to go that route too. And so all I'm stating and sharing is that, like, if you want to have a successful risk mitigated portfolio, you should at least have at least 30% in real estate backed securities. And there's a lot of different options in that bucket. A good resource for data on that is called Tiger 21. It's an investment group, and they publish private charts on every quarter on what they're investing in. I was a member of Tiger 21 for quite some time. I have fluctuated between them, and now I'm with YPO, which is Young Presidents Organization. But in my time at Tiger 21, they did share data on the portfolio allocation. And so I like to share that as a big picture, that if you're investing in commodities, public stocks, private stocks, whatever, just make sure you're at least 30% real estate. And so, I'm sure Christina can advise on what different, options of real estate. There's a lot of different options, but that's kind of what I meant is, if you want to be well diversified in your investment portfolio, make sure to at least keep 30% reserved for real estate. I'm a bad example because I'm like 100% real estate.
Yeah, I'm a bad example too. I'm actually very heavily into real estate, and only a small percentage, less than a third of my portfolio now, because I've sold off stocks. Less than a third of my portfolio is in stocks, bonds, any of those more passive styles. So I'm a bad example too, truth be told.
But yeah,
and that kind of goes to the different options within real estate that Jason was hitting on, right? Your core and your value add, your opportunistic buckets. You can be heavily invested in your real estate, 80% of your portfolio, but really move up and down the risk spectrum. And whether it's a stabilized asset that has cash flow or opportunistic play, like we're going to talk about with development, has a 2 or 3 year lead time before any potential cash could come from it.
Hey, you've seen my portfolio, Clem. Absolutely. I years ago started bracketing out my portfolio, and I encourage other people to do the same. Exactly what you just described. Nice. You want to have it bracketed out, steady income.
And being on and on the debt side as well, there's great websites now that you can crowdsource and crowdfund debt, being a part of tranching different loans. And I don't know if people know about Peer Street, but that's a good way if you want to get exposure to the debt side of real estate. It's hard to make loans on your own balance sheet and to make private loans in commercial real estate, but there are websites out there that help crowdfund debt notes, and you can get access to that type of yield and risk spectrum as well.
So Clem, can you put that stuff, the Tiger 21, the Peer Street, and the crowdfunding websites you recommend, can you put that in the chat box for other people?
Absolutely.
That would be lovely. Thank you.
Yeah, and I think to note is, this is going to be recorded, and if you guys would like, you can reach out to me directly. And I was talking with Marcus earlier today, in the breakout rooms. I love the breakout rooms. It's a good way to kind of connect. By the way, like when you're in different investment groups like YPO or Tiger 21, they're doing the exact same thing that For Investors by Investors are doing. It's great that you have an investment group that's that you're comfortable with, and it's intimate and it's local to where you're doing business. So there's no need to go to other groups, because we're doing exactly what other groups are doing. And I like FIBI, and that's why I support it. So I wanted to share a little bit of my story and how I got to where I'm at, because in speaking with Marcus and a couple others, I think we're, all interested in building wealth and letting our money work for us, right? And we've all read Rich Dad, Poor Dad, or How to Win Friends and Influence People. And if you haven't, read those books first, and then there's a lot of other books we can recommend. But like, I was traditionally trained as an architect, and I have this slide here, and I'm just going to kind of go to the next kind of slide. And what I'm going to do is, I'm going to walk through this as kind of a guiding point, but I'm not going to read word for word. So currently, right now, we're building, me and Clem and our team are building about 150 units in Southern California coastal communities. We're building the core, which means we're building apartment buildings, and we're going to hold them for at least 5 to 10 years, 10 years being the opportunity zone projects to get the opportunity zone tax incentives. And we're more interested in slow growth, right? Rather than building townhomes and selling them, or building homes and selling them. We would prefer to build an apartment building and sell it and hold it to mitigate market risk, and be able to have the opportunity to sell or trade that when the opportunity is right. And so that's kind of a synopsis of our business strategy. But what I think is interesting is that I didn't just fall into this, right? I think the other gentleman, Kurt, mentioned it's like, you got to work, right? You can't just dream it. You got to work. And so, regardless of political position, when we were all going through hard times, our president at the time said, yes, we can. And I was in a place where it was kind of like there was no work. I was an architect, it was very depressing, and I just kept I took the job that was like underpaid and overworked so I can get that investment. I can get that kind of experience, right? And through that process, I gained experience, right? And that was what was key. And so I originally started at the Jurdy Partnership. I studied architecture, right? I worked at the Jurdy Partnership for quite some time. And it was crazy because I was designing 7-star hotels in Dubai, casinos in the United States. It was like way over the top. 2008 hit, all the projects got sliced. And I was like scrambling to try to figure out what I was going to do next. And like, I could tell you the pitch, but I'm telling you the real story right now, right? I'm going to tell you the good, bad, and ugly. And I fell into like working for doing land use and entitlements. And I was like, I've never done that before, really. And I don't know what it really entails, but the guy was pretty persuasive, and I took the job. And it was in my city too, so like I didn't have to drive far. And I started doing land use and entitlements for the industrial conversion of campuses to creative office in 2012, 13, 14. This was before the cat got out of the bag, before it was cool. And my first question was like, I'm not playing. I was like, hey boss, what does entitlements mean? And like, he almost hit me in my head. It was like, what do you mean you don't know what that means? You're an architect. I was like, I don't know. I'm a designer, And I soon learned through the School of Hard Knocks, how to entitle properties in Santa Monica. And I was like, man, I suck at this because I'm not very good at this. And I realized that Santa Monica is very hard to do entitlements on. And I also focused on Culver City in Los Angeles. And through my 7-year period, I got really good at this. I'm really good with people. I love people, you know, I love, you know, life, you know, and so I started to understand what development meant and what I got into architecture because I was naive. I was like, I'm going to design the world, and you know, the world's my oyster. And then I got like hit on the back of the head by developers like, what are you doing? Don't design it that way. I want you to design it how I want to do it. And I was like, oh, so I'm not the boss. Okay. So I ended up saying, okay, I want to study real estate development. Right? And so I applied to a bunch of real estate development schools. I didn't get in. Right? I could boast all I want, but I'll tell you the real truth. I did not get into the MRED program. Right? Clem down here, the guy, the smart guy, he got in. He was one of the scholars, right? But I did get in. I don't know how. They mixed up my application. Maybe it was misspelled, or I'm not sure. The GMAT, all that stuff, terrible. I wouldn't even share the scores. So if you get a bad score, don't worry about it. I got into USC and Columbia for architecture. Right? Probably a low bar. I don't know. I'm sorry for the architects in the call, but I got in. But I chose those schools because they had certificates in real estate development. And if you get good grades and you work your ass off, excuse my language, you can go to all the schools. You can go to the real estate development school, the MBA school, the engineering school, and the law school. And you know what I did? I chose USC, and I was the guy passing out business cards. I was the guy translating my pitch decks in Chinese. I was like shaking hands, going to every single meeting. I had a double major, I had architecture and real estate development, and I worked in land use. So I had zero excuses. And before I got into school, I proposed to my wife or my fiance, and I was planning a wedding, which was very difficult. So I wouldn't recommend all of those. And so I ended up doing really well because I was determined to do well. I had to do well. There was no option for me to fail. There was no option for me to make excuses. I stayed up all night, every night. I at least got 3 hours of sleep. I didn't drink coffee. I only drank water. And I just tried to keep my health and my mind straight. And I was able to get, I interviewed, and for those that are on the call, Clem doesn't know this, and this is kind of something I'm sharing with him. I interviewed at 30 companies, and I had 90 interviews. I got one job for $50,000 as a development manager, underpaid, overworked. Every day I get stuff in the back of my head. Go get me coffee. Yes, sir. Right. But it gave me the title. Right. And I was able to get in, right, where I fit in. Right. It's a reference for a song, but we won't go there. And so I was like, okay, I got this job. Now what do? I learned the underwriting. I learned how to build hotels. I learned how to get the entitlements. I learned as much as I can because that's the value of that job. Right? It wasn't the paycheck. I was barely getting by. And like miraculously, somehow I got a phone call on my desk while I was at my desk. And it was a recruiter calling my desk at my company asking if I wanted to get a job at Ensemble Investments. And I was like, oh, yeah, what is the pay? You know, and it was like double what I was making. I was like, oh, maybe I'll take the interview. Maybe I'm busy. Hold on. I'm ready. We can do it right now. You know? And I actually got the job. And that was God helping me. That was the light, you know. And, you know, if those are not religious, you know, that was just the moment or the universe or however. But, you know, that's kind of my belief, you know. And so I took the job.
We welcome beliefs here. And it's good to translate it to whatever belief you have in your own life about God, the greater good, being good-hearted, having a good opportunity. It's all good.
Right. Okay. So Jesus spoke and said, hey, here's an opportunity for you, right? And I was like, okay, let me take this opportunity. And I did. And I shined because coincidentally, I know real estate entitlements. I know design. I studied real estate development. I needed the opportunity to put it to work. And so I ended up building this project here in Pasadena. You guys might know it. It's where the old Macy's was on the 2-story kind of parking structure. Yeah. And so I was pitching the deal to city council. Guess what? They approved it. And I worked with the head building official to get the permits to build the project, and it got approved. And I actually sourced 7 contractors and select TV Panic to build it. I also was able to help select the bank, which was East West Bank, which is also in your neighborhood. Great to work with. And we ended up delivering the project on time and on budget. It was $28,750. I remember the exact number. Trust me, when you build stuff like that, you kind of have to remember the number. And at that time, I was managing 7 large projects like this. 7. And I didn't know I had it in me. I didn't know that. And what I did is, you know, once my wife had her first kid, and, you know, I almost said when we had our kid, but she had the kid, I was there, right? I love that line, by the way. I use it all the time. And I go, you know what? Let's try our own project, right? And I made so many mistakes. Like my first 2 projects, if you had a list of mistakes to avoid, guess what? I was A+ on mistakes, right? My first 2 projects. But what I did is I had an investor that wanted to invest all the money. He left me hanging last second, right? So like, okay, well, let me call all my USC friends to aggregate capital. Weirdly enough, I was able to raise $1.5 million. I'm an architect. I didn't even know I could do that. And then I got a bank to say, yeah, sure, we'll do it. I was like, really? But you need a guarantor to sign with you. So I took this guy from Harvard Investment Group out for, he likes mushroom soups. I was like, hey, you want some mushroom soup? I'll buy you some mushroom soup. And I took him to a place and I bought a mushroom soup, that's for sure. And I go, hey, if you sign this loan, like, I'll let you be the GC and I'll buy you $100,000, right? I'll give you $100,000. And he thought about it and he said, okay, we'll do it. And I was like, really? Right? Like, it was all this crazy coincidences that were just happening. And so I was like, okay, you know, like, if you guys are into The Secret, maybe it's, you know, just the secret of just kind of thinking, and, you know, there's all the different kind of ways of thinking about how this all came about. But I was on my way to build this. And so I was working full-time at Ensemble, building this. I had this apartment building that I was letting cash flow in Redondo Beach. Here I can kind of show you the project here. It's this one here on the upper left here. And I ended up, you know, getting permits, knocking it down, building Ocean View townhomes and selling them for $2-3 million each. I got away without losing my shirt. You know, all the investors made cash. I didn't make anything, but I worked for like 2 years and I did not complain. I said, you know what? This is the blood, sweat, and tears I got to put in, right? This, you know, and then we bought an apartment building in El Segundo, and we did a value add, and, you know, it was a successful project, and it's in El Segundo now, and it's cash flowing. It's beautiful. And we also, through the course of this, I also did fee development. So I ended up hiring a couple of people from USC that were way smarter than me. They're the ones that got in the programs, right? And I ended up doing a hotel renovation in Burbank. If you guys might know, it's the Hampton Inn out there. And we added some keys, and that's added cash flow. And then I got my Hermosa 1 project, my Hermosa 2 project, my West Hollywood project. And so what happened is it started exponentially growing, right? Because I had staff and I never paid myself. I drive a 10-year-old car, right? I had an apartment at the time. I rented my apartment. Everything I made, I paid better staff. I got an office. I try to upgrade my accounting, my legal, all my systems. I invested in my company, my systems, and my staff. My salary was lower than my staff's salary. Mm-hmm. I actually didn't pay. Clem probably doesn't know this, but I didn't pay myself for 3 years. I didn't pay myself, right? And my wife was pretty pissed off. Excuse my language, but she was pissed, like, dude, what are you doing? You know? And I had this long vision, right? And so what I did is I started saying, you know what, there's too much work, and it might not be for everybody, but for me, there was a lot of work in building for-sale townhomes and not enough juice to squeeze. So what I started doing is I started doing joint venture partnerships with landowners to untrap their trapped equity. So they have equity in their land. And what they do is we get an appraisal. We allow them to invest their value of their land into an LLC that I manage. I get a bank loan to refinance that capital out. We pay the landowner a little bit of capital. He might need like $1 million. Then we use the additional capital to get permit ready, right? And then once it's permit ready, we bring LPs in to go vertical, right? And so that was our Mar Vista project and our 2 Long Beach projects. And then also we have another strategy in which we do extended escrows, right? And so I've accumulated a staff that, you know, is very, very seasoned. You know, Clem, Butler, you know, I was very happy that when he came to us from a private equity firm. I've learned so much tremendously from him. You know, I know that we have some great synergies. He makes me a better manager, helps me with risk mitigation. We got Ben O'Neill on the team that just came from KB Homes. He just delivered 1,100 units, right? And like all these people coming from these huge institutions. I came from an institutional background and I started this company. Then these guys all joined me saying like, we're with you. And so, you know, we have board members. We have, you know, if you guys want great legal, I would suggest, you know, working with Jeff Love with Gibbs Gibbon, Noble Street Advisors, excellent accounting firm. You guys might know James Bohan. He does our tax accounting. He's an opportunity expert, opportunity zone expert. And we use RealPage. And so this is the slide that kind of highlights, if you don't have a lot of equity, right, and you want to do a flip, right, or you want to buy a home, or you want to do whatever, think about alternative ways to do it. So this is my secret sauce. And if you can repeat this, God bless you. This is not a secret. Go for it, right? The first one was joint venture with landowners, right? A lot of landowners own land. They don't want to sell it, but they want to increase their NOI. The first example, his NOI was like $150,000 a year. The new NOI is going to be $1.6 million a year. Is he happy? Absolutely. Am I happy? Yes, I am. Right? And he's 92, and he said, once we get a shovel in the ground, I have 10 other properties. We'll do the same thing over and over. The second one is a seller carry. So for those that don't know what that is, it's important to note that if you want to buy a property, you can make the property owner the bank, and he makes 6%. So you say, hey, I want to buy your property, but over the, call it 6 months or 12 months that you're buying a property to get permits to renovate it, right? The owner could, you know, carry that note. And then once the property's renovated, you can sell it, and then you pay off his portion and you make your profit. And another way to do it for bigger projects, if you have a bigger vision, is you can talk to the owner and say, once I get permits, I'll buy the property. So you run your 18-month entitlement process. Maybe you have a little bit down, and then you do that. So that's kind of, you know, that, and like be very selective, right? So don't be a yes guy, and don't just do a deal because you want to do a deal. And don't let your pride get in your way, and don't let your emotions get in your way. And you know, like the good book says, is always make sure you have advisors. Make sure you have advisors. Christina's a great advisor. Kurt's a great advisor. You know, and advisors have nothing to, you know, like no vested interest. They're a sounding board to you. And if I can imagine, if my son that's 4 years old or my 2-year-old asks me a question that's like he wants to do something that's very dangerous, I'll probably say, yeah, that sounds fun, but maybe try it this way, because I'm a caring dad or a friend or a family or a loved one. And so we're all an investment community. Nobody wants anybody to fail, right? If you guys all succeed, this group succeeds. If one person fails, we all fail a little bit, right? And so we say no to 99% of our deals, right? And I thought I was strict. Like Clem Butler says no to more things. Like if I say yes to 1 out of 100, he says no to like one of 9 of the 10 I said yes to. And so he's coming from like institutional underwriting background. I'm coming from a land use development strategy background, right? And so once it gets in, and I'm going to give you some juicy information, but I wanted to lead up to it so you understand my perspective and where I've came from, right? I didn't just fall into this. My dad doesn't have a real estate company that I just took over, right? I don't have I didn't get inherited $20 million. And for those that did, that's awesome. More power to you. Invest with Christina and Kurt. They'll put that money to work. But for me, like, I'm just talking from the ground up, right? And this is possible for anybody, right? I used to be a waiter at Elephant Bar and a bartender at Black Angus, and I was a bag boy at Ralph's and Costco, right? So keep me real. I'm not trying to boast. I'm just trying to share, right? And so our focus right now, we've realized that it takes just as much effort to build a 3-unit as it does to build a 50-unit, right? Okay. So we're focusing on 30 to 50 unit projects right now, and there's phase 2. Our phase 1 is all like for sale townhomes. Our phase 2 are 30 to 50 unit apartment buildings. That's a term that Clem coined. So I'm just copying Clem's clever pitch here. And so we like to do everything 5 to 10 year holds. The reason why we do that is because we're not dependent on the exit cap. A lot of the time people are like, what's the cap rate? And you're like, what's the ROC? And you're like, well, does it really matter, because we're not building it to sell it. We're building it to hold it. The real question is, what's your cash on cash return? What's your IRR? And what's your equity multiple? Those are the real questions you want to ask if someone's asking you to invest into like a real estate, hold strategy. And I'm not going to get into the development spreads, but usually you want at least 150 basis point spread. So we usually build to a 6% return on cost, which is like your NOI divided by your overall cost. That's your kind of your spread there. We're doing middle market, right? And so I built ocean view townhomes with views for days and fancy golden toilets. I'm over it. It's cool, but I did it. I'm over it. I'm done. I would rather build like affordable housing, workforce housing, that's well thoughtfully designed. Just because it doesn't cost a lot doesn't mean you can't put a lot of thought into it. Like, imagine writing a song, right? How much extra money does it cost to write a really good song versus a very terrible song, right? Nothing. You just are creative and you think about it, right? Just like how much more expensive it is to be nice to your wife. Not zero, right? So be nice to your wife, guys.
Good advice. Be nice to the wife. I'm gonna punctuate that one right there. Being a wife myself.
Yeah, exactly. And so one thing to note though, guys, we're not a everything shop, right? And I would advise against being an everything shop. Personally, like, we're not the architects. We hire architects. We're not the bank. We use banks. We're not the contractor. We hire contractors. We're not the property manager. We hire property managers, right? Because a developer and an investment manager, if you're going to build a home, right? Or if you're doing a flip, Christina, right? Or whatever kind of stage you are in, right? And all of those stages are very valuable. You can build wealth buying homes with the garage in the back and making ADUs out of it and doing it 100 times, you'll be fine.
Right.
You don't have to do like these huge projects.
Nope.
But don't try to do everything. Use other people's time. It's the law of economics, right? You need to use people's time to allow you to have free time, right? Because that's the most expensive thing in the world is your time. So we do GMP contracts. We do BIM coordination, which means we coordinate everything with 3D modeling before we build it. We do a little bit of modular construction and prefabrication. We also do mechanical vertical parking stackers, which just allows us to provide parking when it's kind of usually very, very difficult. And we do we hire third-party property managers. And if you want a recommendation, I would recommend Commons US. They do traditional leasing and flexible leasing. And what I mean by that is they do co-living, right? And so, Clem, would you mind giving them a quick overview of what co-living is? I think it would be helpful because he has it down a little more smooth than I do. So.
Co-living is just another fancy word for living with roommates at the end of the day, right? It's something that we've all been doing to make living in great areas, urban, coastal areas in Southern California affordable. You live with roommates, but why it now has that co-living term, and kind of the property managers that are in the space now, is that they're leveraging technology to help make it more convenient for the residents. You're able to get verified as a tenant much quicker, do background checks, pay your down deposit over an app. So basically just using technology versus using Craigslist to find roommates. Is kind of the quick overview, but then the convenience factor is most of the co-living operators are making their units fully furnished. So they already have the couch, the rugs, the TVs, they have the bed, the nightstand, salt and pepper, olive oil, all of your shared goods. So it's a fully furnished unit, which adds to that convenience factor. And you rent, again, you just rent a bedroom. So it is that roommate living. So I like to say that they unbundle the lease. Right now we have a lot of 1 bedrooms and 2 bedrooms in the market. And if you're trying to, 1 bedrooms are very expensive, studios are very expensive. You go to a 2 bedroom to try and save money a little bit, but you have to find a roommate yourself. You both have to sign a long-term lease together. And if something happens to your roommate's job, then you're stuck trying to fill the spot with another bedroom with your roommate. Whereas co-living unbundled that lease, and they're letting people, just have a roommate agreement under a master lease of that unit. So each unit, you may have a 3-bedroom or 4-bedroom unit that has its own lease for the unit, and then you have 4 different roommate agreements within that unit, which just makes it more convenient and more affordable for the tenant. But we also like it as developers because it's the only way to kind of increase density within the envelope. In Southern California, it's hard to increase housing supply. It's hard to go vertical. It's expensive to go down for parking. Parking is always a limiting factor on any new development. So if having smart design to increase the density within the same envelope. So that's another thing with thoughtful co-living is you can take what would normally be a 2-bedroom, 2-bath unit, maybe 850 or 900 square feet, and you can thoughtfully make it a 3-bedroom unit that still works great for 3 people, and then you can lease it to 3 people. So those 3 people are able to pay a lower nominal rent on a monthly basis. As a developer and an owner, you can have a larger NOI as well, because the increase in operating expenses doesn't offset that increase in rent.
Right, and I think that's a great overview, and I think me and Clem, from us going from for sale townhomes to a for rent model, we wanted to one, get more yield, right, for more return for everybody's capital, and also what we wanted to do is we wanted to provide affordable housing, right? So if you think about it, it's this weird kind of anomaly is where we're providing affordable housing for the end user, right? But also we're making more money, right? And so we're actually doing co-living on all of our projects, and I'll give you some more statistics at the end. But so that's kind of an overview. And so our pipeline has, and this is only really to show kind of what we're doing, not to pitch, right? But we're currently building a 27 unit in Mar Vista on Washington. We're building a 30 unit mixed use project on Catalina Avenue in Redondo Beach. We're building a co-working operation in Hermosa Beach on the water, not on the water, but on the sand, and then we're also doing a 69 unit project in Long Beach on Opportunity Zone. And we're also building a 24 unit project in Long Beach as well, right? And so you can say it escalated quickly, but no one's going to know all the little battles, right? No one's really going to know all the little things, the late nights, the early mornings, the sacrifices we all had to do to get where we're at, right? And growing up, you're like, oh, that rich guy, he got it easy, or all those rich kids got it easy. Like, you don't know what those people had to do to get there, right? And it's diligence. Right? It's saying no to 99% of the things. It's saying yes to the right thing. And trusting your advisors, right? Like, Clem disagrees with me sometimes. And you know what? He's not shy to disagree. And iron sharpens iron, right? And I didn't make that lineup, right? It's in the books, right? And so it's just like one of those things that you're like, wow, it's pretty interesting that you have these smart people, like Kurt said, your five best friends or your 5 network people or the people that you partner with, like get 5 people that are way better than you at stuff that you don't know about. And to collectively, you guys are unstoppable, right? And so I think some of the things that are interesting with co-living right now, and I'll share this data with you, right? The question would be like, so what's happening during COVID, right? That was the lead up to the now, right?
Good.
What is what's happening? So I'll say from building ownership in a company owner perspective, debt froze immediately. All debt markets froze, just like overnight. All of our debt providers froze up. All of our co-GP providers froze up. We had multiple term sheets for $20 million and this and that and the other thing. We can talk all day, but it froze, right? And equity, it was strange because it's like a frozen lake that kind of like the surface was broken, so the water's cold, but it's not quite frozen. I think it was weird because like the stock market crashed, and it was very volatile, and everybody pulled their capital out, and so we got an influx of capital for real estate-backed securities because I think it's the wisest real estate. I think real estate is one of the wisest investments because it's a real estate-backed security and it's a tangible asset and you can actually go look at it. And I know that's in the books and I know that's a phrase that we all have learned, but it's real, right? But the country was built on real estate and the stock market. So you can't knock the stock market. But, I like stuff that doesn't depend on people tweeting, right? Or that volatility. It's a crazy thing to happen when you have that influence. Right? It seems illogical, right? And so that was something that Clem and I worked through. And so what we did.
And I'll put some specifics on that real quick on like the debt front. Like debt froze for a month and a half, all of April, the last part of March. It was mid-May until some lenders started wanting to talk to us again. And all of a sudden you saw all 3 levers were doubled down on by the lender. So rates were higher, points were higher, and structure was more conservative, more favorable to the lender. So we automatically saw rates that we were getting in the 6 to 7% was jumping to 8 to 9%. Origination points were previously at 50 bips to 1 point, was jumping up to 3 points. And then on the structure side, they were hitting us every way there too, with more net worth, more liquidity requirements, holding back more cash, so not wanting to do any cash out from the deal. If you did have proceeds from a loan, they're holding it in a holdback reserve, and you would have to go and request draws for those dollars. So just a lot more management of any cash proceeds. Whereas pre-COVID, it was no problem to have a cash out and to easily withdraw proceeds from a refinance or loans. But those were the 3 things we saw very quickly. The banks, just pulling all 3 of their levers, making debt much more harder to close. What drives real estate value? A lot of it, it's jobs and debt. And if you don't have access to debt, value plummets quickly. And fortunately, there weren't really many trades and haven't been many trades during this time period. So value is still shaking out. But the next piece that we're seeing on the COVID, or being in the pandemic and development, is everyone asks, okay, they still want a deal. So I ask, all right, well, have you renegotiated your land price, or have you renegotiated your GC, your contract for hard costs? They want to know, have you retraded and gotten a deal? That's one question we field every day when we're talking to potential investors. Like, what did you buy your land at? Oh, that was pre-COVID pricing. Oh, they don't get excited about it. And they're like, have you seen any decrease on hard costs? And like, we're doing our second round of bidding with our general contractor now. We're expecting a 10% decrease, but that's what we're expecting, but we haven't seen it yet. But everyone still wants to see a deal and to see that decrease in price. But I think we haven't really seen it materialize in the marketplace yet. just
No,
a few side points.
That's good, Clem. Thanks for jumping in on that and giving us more sort of like the details to, you know, to say, well, you know, the points were this and the terms have been this, and whether you've actually seen the blood on the streets actually become something or not yet. Because that is what everybody's been asking
rents
about.
have fallen. Rents have fallen for sure. I mean, people aren't moving right now. Right? Unemployment goes up and people don't want to leave, don't want to move into a new apartment. So there's not that transition of people moving up into nicer apartments. At least not in the, if you're wealthy, you may be moving to a larger apartment for more space or something. But when unemployment increases, you just automatically have rent doesn't grow. And so the rents we've been tracking are like the Mar Vista, Culver City, South Bay. I mean, at least in the co-living world, what used to be a $1,600 or $1,700 a month rent is now asking $1,300 a month. What used to be for a brand new construction, Greystar managed building, would have a month of concessions or 3 weeks of concessions, and now 2 months of concessions up front. You're definitely, rents are definitely being hit right now, but again, it's because people aren't moving. People aren't really hiring, and got a lot of people that lost their jobs, and people aren't moving around. And unfortunately, it's going to probably be that way for another 9 months or more. And then things will jump back. But unemployment drives real estate, and debt drives real estate. So until we can get the debt markets back going again, and we see rates are, I mean, you've got the 10-year treasury at 60 bips or something, right? And 30-year mortgages are below 3%. So the lenders in the commercial real estate world, I think, at least on the value add side and renovation side and more riskier side, the rates are going to start to come back down, and we'll get to do deals again. But right now, the increase in rate isn't making sense for what sellers still want on their assets. So it's really keeping deals from transacting when we're looking at new deals now, at least.
That's a good description. So let me try to repeat it. So it sounds like that you're not really seeing blood on the streets, that you're still seeing that what is being sold or being offered up for is close to pre-COVID prices, let's put it that way.
Absolutely.
But you're not necessarily seeing the construction prices go down, but you are seeing the banks.
We haven't yet.
As of yet, but you are seeing the banks are putting out, you could call it more aggressive products, I guess, and that there are higher points, there are higher interest rates, and they're looking for stronger terms to sort of manage their risk on their side, which means you're probably not really, I mean, that would naturally, I would think, start squeezing the margins on deals that you guys are considering. If you're considering any deals right now at all, are you considering any deals right now, or is it just impossible to find them? And Jason or Clem, either one of you can talk to this.
Yeah, I could. Go ahead.
I'll say we have 4 deals in the pipeline right now that are active that we're working on, but we've acquired, but we need, to get the debt to capitalize them. We're trying to raise the equity to capitalize them, and we bought these deals at pre-COVID pricing, and these deals would have been already financed and fully capitalized if we weren't in a pandemic. But now everybody, the equity partners and the institutional LPs that we're talking to, they all do want to see that increased return. And we can't just pull it out of the hat right now, because we're not going to say that rents are going to trend at 5% for 24 months. And but over the long term, things should jump back, and you should see rent growth. We're also not going to model out 3% rent growth or no % rent growth for the next 2 months, and then 5%, 7%, 9%, like something like that could be very, very likely. But you're not going to put that in mind. You can't raise money that way, right? But in the deals that we're looking now, and we're still talking about, sellers still want pre-COVID pricing. They still think their land is worth what it was worth 6 months ago. And that just can't be the case, because as we go forward, occupancy has to decrease across buildings. You just have to, the 95% or 5% vacancy rate on things just has to increase, knowing that, or you factor it for it in concession loss or bad debt. But we're going to now live in a world where pandemics are real, and we can shut down our economies at any given moment, and we have to learn how to increase our maintenance of our properties to keep them more hygienic. So there's just going to be a larger cost to owning and operating real estate, and so with that, either pay less for it up front. I think we'll get savings a little bit, because debt is going to become cheaper. debt will be more available, so that'll offset some of the decrease in cost. You can increase your cost a little bit when your debt's cheaper, right? Those are just kind of high level concepts.
No, that's good.
Right.
Jason, you want to add to that?
Yeah, no,
Jason.
all I was gonna say, so like that's all the blood, you know, and like we were able to turn, you know, the water into wine in a way, in not listening to fully that when we're looking for debt, all the brokers are saying pigs are flying, sell all your properties, run for the hills, it's all over, right? And so what we did is we did a calling all brokers, calling all shops, calling everything, calling everybody, right?
Yeah.
And this is me with relationships at HFF, JLL, George Smith Partners, all the big guys. And what we did is we were able to source our own debt refinance for about $10 million worth of property, right? During COVID, and we were able to get pre-COVID prices, right?
Okay.
And don't get me wrong, like all that we just talked about, that blood, sweat, and tears, that was real. It was not easy, right?
Right.
Me
That's
and
a lot of
Clem,
work to refinance $10 million worth of structure on your buildings in the middle of banks essentially not really wanting to be responsive at all. I mean, I've had problems financing a single family in Indianapolis.
right? And so, like, I'm going to share, you know, the sources right now, right? And so, on top of that, on top of me looking to refinance two of my properties, one in Mar Vista, the other one in Long Beach, I was also in the middle of looking to refinance my own personal home during COVID.
Right.
So imagine the complexity and stress over that period, right? Me and Clem seen outrageous numbers coming from the pool sharks of the world, right? We were like, wow, this is unbelievable. And through the thick and thin of it, we found a great partner, okay, called Asset-Based Lending Partners, okay? If you want a warm introduction, they do multifamily and they do commercial, bridge notes at great prices, pre-COVID prices. And I can give you a warm introduction. We actually just closed on our Mar Vista refinance with the cash out for pre-development. And we also are closing our second deal next week with them, right? The second one was I wanted to refinance my home because rates dropped, right? And it was like, oh, this is great. And then COVID hit and we're like, this is not so great. What's going on? It was weird. But I was actually able to refinance my home in the low threes let me get the name here. It's Lonix.
Lennox, yeah.
Yeah, it's LOGIX. Okay.
Yeah.
And if you guys want a warm introduction, I can give you one. But they regardless of COVID and my financials and all that stuff, like if I didn't go with that bank, it wasn't going to happen, right? And I would have had to wait till the next turn. And so I highly recommend if you need to refinance your home or you need some bridge notes, I can give you guys warm introductions, or you guys can go to them directly. So that was one piece of it, right? It was us doing refinances for our deal. What I think was a saving grace for us was that we actually had already acquired all the properties,
Right.
and then all of our plan checks. So when you do real estate development, you get your architects and your engineers to get drawings together and you submit them to the city, right? We actually got all our comments back right before COVID hit.
Oh,
And
that's
so
helpful.
so we didn't have to wait for the city to give us comments back.
Right.
All of our architects and all our teams were at home with plenty of work to do over the next 3 months because they needed to update and kind of address all the comments, right? And slowly but surely, the debt markets are starting to thaw out, right? They're not pre-COVID by any stretch of the imagination, but they are starting to thaw out, right? And then we're starting to see co-GP and LP and investors hitting the markets. And I've seen like that cold, icy water turn to lukewarm, right?
Okay.
I wouldn't call it summer water that you can swim in for hours and go surfing with your board shorts. That's not it, right? You maybe can go in, but you need a spring suit, right? To just double check, make sure it's
Yep.
cold. Surf, catch a couple, but got to get out quick. And so that's the good news. But what's interesting data, right? The question would be, how is co-living doing, right? How is Commons US doing across their portfolio
Right. Sure.
during COVID? That's
Sure.
the question. Right?
Yeah.
And so I asked the question to the CEO, and they gave me this cute slide right here. I'll show you this cute slide.
So for anybody who doesn't know, commons.com is one of the commons is what's called .com is I think the current forerunner, but Jason, you know better than I do, of co-living, basically being on a website. Like you sign up on a website, you became a commons.com user. And then if you want to move from city to city, you can actually move within the commons.com network. So Jason, does that seem like a good description of who they are?
Yeah, I mean, I think Clem said it a little more detailed in
they're,
which
they're the forerunner. Mm-hmm.
But they're the forerunner, and you kind of become a commons.com user. And if you
Right.
need to change jobs or cities, then you can stay within that same network, and they'll put you in
Right.
another co-living environment.
Yeah, I want them to be more member-based, where you're a member of the community and you can move around the different bedrooms. Currently, right now, you lease a bedroom, a private
Okay.
bedroom.
Okay,
And
so
then
they're not
if
member
you
states.
want to go, if you want to move, if you want to move to another state, you can lease another private bedroom. I
Okay.
think over time it would become more of that member approach, and I envision that for them as well.
There you go. I've never
Right.
used them, so thanks for the clarification.
Oh no, and we're here to share
Mhm.
so that we can all kind of learn together here, right? Like you said. And so I think what's interesting is that Freddie and Fannie, the agencies, have already adopted Commons US proprietary leasing model, right? And what that all means is that so if you have one unit that has 4 bedrooms, there's 4 different leases, right, that are in that one unit. Those all roll up to one lease that's attached to the property. And so the Freddie and Fannies of the world see if you have a 27 unit, you have 27 leases. Right? It meets their underwriting, so you can get the low 3 takeout financing. And so, and I think that if you had a membership, there might be issues with kind of, the risk profile of them because you want to have leases attached to the property. But with that as an aside, we asked them, what were your rent collections for May and June? These guys' rent collection was 96% for May and June across the nation, right? And I was like, because you guys know that nationally the apartments are 80%, right? And so what that means, and you got to pause, that's a very important data point. Co-living literally outperformed traditional apartments during COVID. And I paused for effect because it's important to note that because you think about it, right now, if you sell an apartment building that has a co-living component to it, you usually give it a 50 basis point discount to a market. So if you sold something at an apartment for a 4 cap in West LA, you're projecting a 4.5 cap for your sale for a co-living.
Right.
That's the collar, they call it, is gonna start to shrink. And I believe it's gonna invert because if you have a product that can perform well in a fluctuating economy, that's the definition of risk mitigation. Right? Right. And so I was like, this is a cute little kind of like diagram. I want to see the data. I hounded these guys. And so I was like, oh, great. Like, let's take a look at the data. And they're saying the average age of the population, of their people are 30 years old, average income 120 or 130, right? Excuse me. This was developed for people that were for $60,000 a year, $70,000, $80,000 a year, entry level. But what this shows is people that make more money actually want to live in these locations, right? And so
the convenience that co-living provides and the community that the operator provides, that's why people are choosing this type. They can afford to live on their own, but they prioritize either saving money and or living in this type of convenient community atmosphere. And as we go forward in real estate, right, interest rates are super low. They can only go so much lower. Cap rates are ultra low. They can only go so much lower. Cap rate compression has been like this for the past 15 years, from 10 caps now down to 4 caps. They can only go so much lower. So the way we're going to find value and increase the value of our real estate assets is through operations. So being able to partner, either you have to be an awesome operator, or you have to partner with great operators to maximize your efficiency so you can decrease your operating costs and maximize your revenue to boost NOI, because that's really the only way that we're going to see as owners in real estate to get real appreciation and create real value from our assets has to be from the NOI, because cap rate compression isn't, unless you just are able to buy really well and then below market rate, good below market rate, or buy outside of normal market pricing and sell at market rates. But otherwise you just have to, it's all an operational play and increasing NOI, because cap rates are already so low and they can't go that much lower. So benefiting from a wave of more cap rate compression just, we feel, isn't in the future, as we look to this next expansion. Maybe you see a small compression, but nothing like we have over the past cycle. So partnering with a good operator is one of our priorities, and that's why we've chosen Common as a national leader of co-living assets.
Right, and that's very well said. And there's others, like Ollie. There's other, Star City. There's other competitors, but we don't work for Common, so we're not pitching them. We're not saying I get a kickback or whatever. We're just saying our experience. We've interviewed a lot of them, and we like Common's US. And it's cool because I looked at the raw data and I was like, look at what these guys make. This guy makes $460,000 a year. I was like, but they don't have the name, so I thought it was cool they gave me the raw data. But
that was good.
Anyway,
so all right, let me hijack for a minute. So we've got 15 minutes left.
Okay.
And so I have a question, and I know that a question has come through on our chat box. And also I encourage our listeners, our members now here at the meeting, to put your questions in the chat box. So sorry, Jason, to cut you off, but we're
No, I was kind of wrapping up.
It's cool. So what my question is, Jason, is what are your thoughts on, you are a developer, you need to have a long timeline. COVID itself kind of is almost, in comparison to development, it's almost the same timeline. Like COVID's like 2 years, maybe. We've got, active COVID for 12 months here. Some consider that it might go 18 months, but most people, I think even the medical community, is thinking we'll see 2 or 3 waves of COVID come through, and then we'll have a much better handle on it medically, as far as treatments and being able to do a vaccine. How is that affecting your viewpoint as a company in being able to continue to purchase? Are you guys not looking to purchase right now because you have 4 active projects? Are you holding off and doing any more investigating for a year, 2 years, 3 years? What are your thoughts on how it's going to affect your company?
Right. And, reading Clem's mind here, I'll share with you what we're thinking is, our pipeline's full. Like, we have a strong pipeline that we've been able to accumulate over our lifetimes, right? And so this isn't like, it's not a coincidence that you meet me right now and I'm full and I have a pipeline that we're very happy with. All the locations are A+. We've chosen the right architects, contractors, and operators and staff to run it. And we're going to hyper focus on delivering what we have. Hyper focus, making sure it's exactly right. It's like we're going to rehearse the song before we perform, right? And instead of having 1 rehearsal, we'll have 10. And we're going to do it and we're going to tune our instruments, and we're going to have brand new strings, and we're going to fine tune everything, and we're going to play it and play our hearts out, right? And so I think right now with COVID, no one has a crystal ball. We all got to pull together. We all got to, work hard. But there's a fundamental crisis that everybody's lost sight of, right? And if you attend the Lusk Center of Real Estate, multifamily data kind of presentation every year at USC, UCLA has a similar at Zimmerman. They give you the statistics of the housing crisis. California housing crisis states that there's a demand of 200,000 units per year to come up to be able to be at par with demand. And we've only been able to provide 100,000 units per year over the last 4 years. So what that means is rent goes up, housing sales go up, there's more homelessness, there's more struggle. And the only way to actually combat that is to provide more housing. right? And so I think that one solution, which I think was well done by the government, I know that whole sentence is very strange to say in one sentence,
Yeah, they
but I'll
don't always go together.
right, is they passed the ADU ordinance, right? Where you can actually build a second unit if you have a single family home. And if you have a garage, I highly recommend you do it because it actually adds value to your property. That adds density to a horizontal landscape we call Los Angeles County, right? And what's making it very difficult is the entitlements are very difficult to get in LA. And which is the silver lining right now, which is very strange, is guess what? City officials could use email also. It's weird that they also could use Zoom now. It's so strange. And you're like, yeah, we've been doing it for years. Like, you guys are just waking up now. And so it's been much more efficient to actually get permits because people are actually being like, and I'm on Zoom calls with these city officials, and sorry if anybody that works at the city, I'm like, how's your schedule look this week? And they're like, oh, we're wide open. And I'm like, if we're all working in the office, you're always so busy, you know, but now all of a sudden you're open for Zoom calls. You know, I'm like, all right. So the synopsis of my answer is that we're full on our pipeline, right? We would be open to joint venture partnerships with landowners. That's a caveat, but we're full. And we believe that us providing housing for the housing crisis is another crisis alongside this health crisis, right? So because we're distracted with the health crisis, we can't be distracted from the housing crisis. Because if you neglect that one kid to take care of the other kid, that kid gets neglected and he becomes kind of like a jailbird and he goes and robs banks and, you know, maybe he gets away and buys his mom a car and everyone loves him, but maybe that doesn't always happen, right? And so you want to make sure you take care of what you need to. And so we're doing our part by providing affordable housing, Clem likes to say with the lowercase a, to people that, you know, are making $60,000, $70,000 a year, workforce housing, and actually providing risk mitigated investments for people to grow wealth, slow growth wealth over a 5-10 year horizon. And we do really, believe in the magic of opportunity zones. And if you don't know, you got to know. I think a high level, the one liner is if you have $1 million gain, you invest it into an opportunity zone over you defer your taxes for 7 years, you get a basis step down of 10%. And then at the 10th year, you get a basis step down of 15.
Right.
But if you're getting a 4X on your capital, or call it a 3X on your capital over those 10 years, your gain from your gain is tax-free.
Right.
If you can understand that magic and then understand the power of real estate-backed securities in your portfolio, you'll be on your way to wealth preservation and being able to kind of help share the knowledge like Christina and Kurt have been able to share with the crew. But it starts somewhere, right? It starts bagging groceries, being a bartender, doing what you need to do, investing small pieces. You can invest $25,000, $5,000 into all these crowdfunding platforms.
Yep.
So you can get in the game and understand, you know. So
if you guys weren't full, and I don't care if Jason or Clem takes this, if you guys weren't full, what do you think would be the strategies of other companies right now that would be needing to look right now, or would they consider not looking right now and just holding on to cash and opportunities until there's less of a wonky push going on between funding and equity and rents? You know, what do you think?
We really like the flexible workspace right now. So I mean, co-working has this another bad like thing on its face because it's co-working and sharing. It's not private, hard to keep clean and manage. But we think going forward, flexible work is going to continue to increase. And work from home, not everybody can continue to work from home the way we're working from home. So you're going to take the work from home and you're going to move your office to some flexible location that you can walk to in your community. So being able to repurpose assets, this goes to a bigger thing of being able to have multi-use from assets. So how can assets be more convertible and have multiple uses over their lifetime? But we believe strongly with this new wave of people are now embracing technology. They're embracing not going to the headquarters in Century City or downtown wherever and using technology to work and working from home, people still want to get out of their house and they still want to have some type of community. So having more satellite locations, more satellite offices, which lends itself well to short-term leases and what would be traditionally called co-working facilities, has a strong future from it.
So COVID isn't
one asset type that we like.
We saw in the numbers that COVID doesn't seem to be impacting the co-living space, even though one would think naturally would. One of our questions, as a matter of fact, has to do with, people moving away from the big city to be less populated, and may also because it's more affordable and they're avoiding the virus. But you feel like that co-living isn't going to really take a big hit from COVID, given what we've seen so far.
Yeah, people want to be in community, I think, and particularly that the generation of people and the age group of people that are living in the co-living buildings, I think, are kind of maybe the ones you see on the news that are maybe they're less worried about the COVID as well. I don't know how much that plays into it, but I think that age group is they have less fear of the virus, right?
Well,
but they also like living in co-live, and they like the community, and we have seen that the micro portfolios have performed very poorly during the pandemic, and I think that goes back to the stay-at-home and quarantine times. We saw a lot of people giving up their micro units, and they had their collections was a lot lower for micro than the co-living unit, which we thought was interesting.
Okay.
And,
so,
Christina,
yes, go ahead.
just to give a couple lines on that is,
sure.
like, we're talking about a fluctuating economy where there's no security in employment, right? So people don't usually want to buy a home, barely rent a home. Maybe you'll rent an apartment or you'll do a roommate system, right? To mitigate risk and overhead. Same thing if you're a startup, right? You don't want a 10-year lease, 5-year lease, 2-year, 1-year lease, right?
Okay.
And so you go into these, we're all working from home, but that doesn't mean the same thing for everybody. That could mean you're working from your home city and you have a private office at XYZ. You got to watch out, because co-working doesn't equal WeWorks. Just like social media doesn't equal MySpace, right?
Right.
Right. You got to watch out, because not all beers are made the same. Not all co-working are made the same. Not all, so you got to be careful, because, we're investing our capital into a co-working space on the beach. And if I told you what happened during COVID, you would not believe me. I was planning to lease out every office and every seat individually, right, for $500 each. We actually got all the offices and all the seats pre-leased during COVID for 3 years.
Wow.
And I can't even make that up. I was just like,
yeah.
Okay, yeah, let me check with my partner. Yeah, let's do that.
We'll go with it. Yeah, that's okay.
That was a Rich Dad Poor Dad quote, by the way. That I didn't make that up.
Very good. Okay, here's a completely odd question, and then we'll wrap it up. It's odd only in that it was actually asked several minutes ago, but I told them they had to wait, and I would ask it later in the night. So,
Very
Jason,
odd.
would you ever be the GC? Some developers like to be the GC to make more profit and control change orders and construction costs. What do you think? Would you ever be the GC to make more profit?
Okay, let me get a toy. Clem, Carl, and Christina, what would your guess be? My answer. What would my answer be?
Absolutely not.
Oh.
Clem?
No.
Everybody A+. You know why? Because there's too much risk mitigation. Like, there's too much risk, and I gotta have arm's length to be a fiduciary to my investors, right? So the answer is this: if I have $10 million of investors and the GC screws up, I need to be able to, 1, mitigate that through liquidated damages, 2, to sue that, or 3, to cure and replace that GC. If I take 10 million bucks and I'm also the GC and I'm also the developer, that's conflict of interest. Some firms are vertically integrated, but successful development firms do not do development. They don't do the construction, excuse me.
You know, the construction part of the development.
Yeah, and so
and they can be vertically integrated, but they're still separate entities. They're under different companies, corporate structures, so, and they're ran separately, because you still need the developer to manage the construction company. If you're doing it together, you need someone to still manage you. It gets convoluted.
And it's a good question. I don't think it was an odd question. I think it's actually one of the best questions we've had all night.
Well,
And I do want to share one bit of advice is that if it's smaller scale and you have the expertise to manage subs, it's different. If you're doing a renovation or a ADU, and you have the experience, right? It's feasible. But if it's a 4-unit, a 3-unit, a 4-unit, a 5-unit, a 10-unit, and you're like a doctor, or you're this high-powered, smart attorney of the world, construction is a whole different animal. It's not a let's learn on the job. Just like I would never learn how to do surgery on the job, right? It's a profession that you don't play with it, and so I wouldn't do it.
Okay, so given what you've described, would you consider starting a separate GC company for you guys? Would that work for you? Do you think that's a good model?
For me personally, I think my time value of money is better used sourcing deals, designing and developing and sourcing capital and building relationships.
Okay, yeah.
So some other people might be like, I love to be a contractor. That's my thing. I love it.
Right.
So it's rare to see builders that are also developers. So, but that's just from my experience. I'm still learning too. So.
That's good. Let me ask one quick question and we'll wrap it up. So somebody wants to know, what's the source of the 80% national apartment average on rent payments? Where'd you get that source for the 80%? It was in one of your slides. It was one that was on common.com, the
Right.
little apartment building one.
Yeah, so this is sourced from Common US. I'm imagining that they're, I can't quote exactly, but they use CoStar a lot. They use apartments data a lot. So if you guys don't know that, it's kind of it's a super expensive software. It's kind of like MLS, but it's for commercial grade. It costs like $1,500 a month.
Yep.
But they pull data from that. So and then Clem also has another software that he used when he was CS Capital. What was it called, Clem?
RealPage. RealPage
Yeah.
is another, just mostly multifamily.
Right.
So Jeff put out in the text box, he's seeing 87.6% on NMHC. So Jeff, what's NMHC for those of us who aren't as smart as you? Jeff Walcha. He's probably on mute. I'll patch the link. Okay, he'll put the link in the chat box.
Right.
So let's so thank you, Jason. Thank you so much, Clem. I always require that you guys share your contact information, that people know how to find you, get a hold of you, and that if any of my meeting participants call you, that you'll be polite and generous with them. But I suspect that's naturally your guys' way of being anyways. So let's make sure we get your contact information out there so that people can say, hey, I really liked how Jason managed XYZ, or gee, Clem really is that smart boy that Jason keeps talking about, and I need to ask him more statistics. So please give us your information so people know how to get a hold of you.
Right. So you can go to beachcitycapital.com, and our email addresses are our first name at beachcitycapital.com. And you can kind of click the link. You can email me here. You can download my resume. I've intelligent investors real estate. That was the FIBI thing, right?
Woo-hoo, woo-hoo.
So yeah, there's a couple of presentations I've done on stage. I'm really happy to help people that have questions when they're starting up. And questions, kind of just any question that I can help you get to the next level. If you're thinking about starting your own company, do it. If you're thinking about investing in real estate, do it, right? And if you're thinking about waiting and thinking people are going to knock on your door and you think opportunities can come to you, not going to happen. And so you guys are doing the right thing by networking. Networking is your net worth, right?
Yeah, that's right. How you treat your network is your net worth. In my version, that's my particular version.
Right, and so you can contact us here. If you wanted to doodle, the cool thing about our website is that you can log on and there's investment memorandums, there's webinars, and you can just check them out just so you can get all the terms and kind of all that stuff, just to learn, And so we're happy to help, and If there's any kind of business questions you might have, please reach out to me and Clem directly. Jason@beachcitycapital.com. My phone number is 310-245-4419. You can text me.
Say it again, 310.
245-4419.
Perfect.
Yeah, and then Clem@beachcitycapital.com. If you want to call him, you can call me.
And then you'll forward them on, right?
Yeah, no, I just,
Let's give him a virtual hand or a woohoo or unmute or thank you guys so much for that. Yep. Nice job. We love it.
Oh, there you go.
That was really good. Thank you for getting to our questions and for being so personable. Also, I mean, you not only gave us statistics and data, but you also gave us the real scoop. What does it take to be a real estate investor and where do people really start? You know, and I started in my sister's hand-me-down clothes in 6th grade and was horribly for it. And, you know, you were a bagger and a waiter. And that's the reality of where a lot of us have started. And we eventually, you know, Kirk started standing up in my meeting and I remember his t-shirt and his shorts and look at him now. He's, you know, practically a professional. Oh my gosh. Right. I mean, we all started somewhere that it wasn't nearly as great as where we end up. And the beauty of all of that is it really is self-determination.
Right.
You decide where you want to go and you commit to it and you'll get there. It may
Never
not
give
happen
up.
this year, right? It may not happen next year. Failure is only when you stop trying. It's not about how many times you fail. It's about, do you choose to try again? Because if you choose to try again, then your commitment, your self-commitment is still intact. You can still move forward with your self-faith and your self-courage standing right with you and being able to make the best next decision. So, so that's my personal, you know, hoopla for the night. So we will have we'll have the FIBI multifamily meeting on August 5th. We are going to have David Coe be on our FIBI multifamily meeting on August 5th. Jason knows David Coe very well. Yeah. And we were teasing about that earlier. And then we'll also have our FIBI Pasadena meeting on August 20th, and it'll be Iris Veneration. So we're going to have her come talk. We will, Kirk, I will let you do the next part of closing the meeting out. He's like, what are you talking about, Christina? We will leave the Zoom up for you guys to chat. Use the chat box, put your information in there. If you have anybody you want to reach out to, this is your chance to privately reach out to the people. We will hang out and make horrible jokes and do our usual shtick for about another 10 or 15 minutes. So feel free to do that, but make sure that you reach out to everybody you want to and use this opportunity to develop your network. Even though we're not standing next to each other, we're still a community and we're still here to help each other. So let's not
I feel like I should rub up your food just to make it feel right.
If anybody wants to ask questions or whatever, you can unmute your video.
Ask questions, mute, chat. And,
yeah, so we can hear. So you can feel free to
Jason and Clem, you're welcome just to hang out as well or not. That is up to you. So
guys, I enjoyed the time. I got 2 babies. I'm going to go tuck them in and give them kisses. But God bless you guys. Work hard. Don't give up. And I fully support FIBI and what you guys are doing. So if you guys want to reach out with any questions, I'm more than happy to take the time to slow down in what I'm doing to help out. So
thanks for sharing, Jason. It was great.
Jason, thanks for being here and, you know, kiss the kids.
All right, guys.
To kiss the kids. Clem, right. I saw your email go into the chat box. You can say goodbye as well.
Yes, thank y'all. It was a great evening. Good luck. Please reach out, shoot me an email. I'd love to connect and continue this conversation.